The market is currently closed, and the last reported closing price for Robinhood Markets Inc. on the NASDAQ under the ticker HOOD was $132.07 as of Wednesday, November 12, 2025. That figure represents an intraday movement of a drop of $3.81 or $2.80%, which is a significant downward pull on a day when the broader market saw mixed results. Now, most people look at Robinhood and see the surface-level narrative, the meme stock darling that pioneered online investment and self-investing for a new generation. They see the headlines about their strong quarterly performance, where the company smashed revenue and earnings estimates, posting a massive 100% year-over-year revenue increase and a stunning 300% surge in crypto transaction revenue in the most recent quarter. The expectation, based on those numbers, should have been a stock that takes off like a rocket. But here is the immediate contrasting reality. Despite beating on both the top and bottom lines, the stock actually declined by nearly 10% in the immediate aftermath of that Q3 earnings announcement. That is the tension in this stock right now, and it is a fascinating paradox that tells us everything about what the market truly worries about beneath the surface of the headline figures. The general belief is that Robinhood, with its commission-free model and highly engaging Robinhood app, is fundamentally an unstoppable growth story built on democratizing finance. It forced the hand of incumbents like Fidelity and Interactive Brokers to drop their own trading fees, and its youthful user base is the supposed long-term key to future asset gathering as that generation accumulates more wealth. That is the expectation. However, the reality the market is pricing in is a much deeper concern about the quality and sustainability of that growth, especially the expenses involved in maintaining it, and the inherent volatility of its main revenue drivers. The core challenge is in their operating expenses, which came in higher than expected for Q3, raising a big question about the company's cost structure as it tries to expand aggressively. You see, a large portion of their outperformance, specifically the incredible 300% surge in crypto transaction revenue, is inherently cyclical and dependent on retail trader sentiment and the overall health of the digital asset markets. When Bitcoin and other cryptocurrencies are running hot, the volume on the Robinhood crypto platform soars. When the market cools, that revenue stream can contract just as quickly. This dependency means that even spectacular earnings are viewed with a skeptical eye because the street fears that one-off trading volatility, not sustainable operational efficiency, drove the upside. This is a stark contrast to a diversified wealth manager like a Fidelity Investments or a Schwab Intelligent Portfolios, which have more predictable, recurring revenue from assets under management and subscription services. The high-flying nature of Robinhood's growth is both its biggest selling point and its most significant liability in the eyes of institutional investors who prioritize consistency. Looking closely at the recent stock movement, the decline following the positive Q3 report was a classic case of high expectations meeting a slightly disappointing outlook on the cost front. Volatility has been the word of the year for HOOD. The stock has been on a remarkable run, soaring over 254% year-to-date, far outpacing many other fintech and brokerage stocks. This massive surge created an incredibly high bar for the company to clear. When they reported fantastic top-line growth but also revealed elevated expenses tied to higher bonus accruals and stock-based compensation, it spooked a segment of the market. The high volume of trading activity on that earnings day, which saw nearly 28.5 million shares trade hands, highlights the sharp divide between the bulls who focused on the revenue beat and the bears who honed in on the cost structure and the upcoming CFO transition, which often creates uncertainty in the market. The volume itself was right in line with the stock's average daily volume, but the concentrated move downward against a backdrop of great numbers suggests that profit-taking by short-term traders after a substantial multi-100% rally amplified the move. This kind of immediate negative reaction to strong earnings is often a sign of a stock that has simply gotten ahead of its fundamentals, trading on a future potential that is priced to absolute perfection. Delving into the institutional activity provides another layer to this dynamic tension. In the last reported quarter, we saw a net positive movement from institutions, with 826 investors adding to their positions versus 479 decreasing them. Notably, massive players like Vanguard Group Inc. significantly added to their stake, a move that provides a powerful stamp of long-term approval and suggests they view the recent volatility as a buying opportunity for a growth stock. On the flip side, some major hedge funds and capital partners substantially removed shares, signaling a rotational move or a belief that the stock's parabolic run had peaked. This split in institutional sentiment perfectly mirrors the split in the wider market narrative. Some see a high-growth fintech poised to become a dominant financial ecosystem. Others see a cyclical, high-beta brokerage stock that has run too far too fast and is dangerously susceptible to shifts in retail investor interest and regulatory winds. The fact that the stock is currently trading at a price-to-tangible book multiple significantly higher than older, more established players, like the figures we see for Fidelity Brokerage, reinforces the notion that a massive growth premium is baked into the price, leaving very little room for operational missteps or market turbulence. Now, let's establish common ground on what Robinhood actually does, since their entire business is a masterclass in market disruption. At its core, Robinhood provides commission-free trading for stocks, ETFs, options, and cryptocurrencies through its user-friendly platform. Their innovation wasn't in the product, but in the distribution and pricing. By pioneering commission-free trading, they completely upended the traditional business model of brokerages, forcing major players from Charles Schwab to Fidelity to eventually follow suit. Their primary revenue stream is through payment for order flow, or PFOF, where they receive small rebates from market makers for routing customer orders. This, along with growing net interest revenue from customer cash balances and margin lending, and an accelerating subscription revenue from Robinhood Gold, forms the scaffolding of their financial engine. Robinhood Gold is key here, as it is a pure subscription model, offering perks like higher interest on brokerage cash and larger instant deposits, which adds a much-needed layer of recurring revenue, moving the company away from its heavy dependence on volatile transaction fees. This is the structural move that analysts love, as it begins to give Robinhood the look and feel of a genuine fintech platform rather than just a brokerage app for online investing. Moving to their strategic expansion, it's clear the company is working aggressively to diversify beyond its retail brokerage roots. Robinhood is not content to just be the top investing site for millennial and Gen Z self-investing. They're actively pushing into wealth management with the acquisition of Trade PMR, which is a clear shot across the bow of established registered investment advisor platforms, aiming to capture the assets of financial advisors. They're also making a major play in the digital asset space with the acquisition of Bitstamp, one of the world's longest-running crypto exchanges with a significant foothold in Europe. This move is particularly important because it positions Robinhood to capitalize on international expansion and potentially become a leader in the fast-growing area of asset tokenization, which essentially involves placing real-world assets onto a blockchain. They are aiming to evolve into a full-scale financial ecosystem, not just a Robinhood stock trading app, with features like 24/7 trading and prediction markets, which further entrench their cultural relevance with their core, younger demographic. The future outlook for Robinhood is intrinsically linked to how well they can navigate the tension between their disruptive growth and the regulatory scrutiny that comes with it, particularly around PFOF and crypto. The expectation is continued exponential growth, driven by their product velocity and international push. The reality, however, is that regulatory headwinds remain a major risk. The SEC and other bodies have consistently scrutinized the practice of PFOF, and any significant change in the rules could meaningfully impact Robinhood's primary revenue source. Similarly, the entire crypto space, which is currently driving a huge chunk of their revenue, operates under regulatory uncertainty, and a sudden crackdown on specific assets or staking services could cool the retail trading frenzy. The real opportunity, The one that could truly exceed expectations lies in their ability to successfully transition from a high-frequency trading platform to a genuine wealth management destination. If they can convert their massive engaged user base into long-term clients who use Robinhood Cash Management, their Fidelity IRAs, and eventually their wealth advisory services, the company's valuation logic will shift entirely. It would move from being valued as a cyclical brokerage, highly sensitive to market swings and interest rates, to a more stable, higher multiple fintech platform with predictable subscription and asset-based fees. This is the growth story that analysts are projecting, with some estimating the potential for a very high earnings per share figure in the coming decade, assuming consistent execution and favorable market conditions. The high-risk, high-reward nature of this stock is precisely